Welcome to the Australian Property Investment Podcast with your host, Aaron-Christie David. Each episode, we ask an expert to share their key insights for aspiring investors to make confident property choices.
G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. My name is Aaron-Christie David, co-founder of Atelier Wealth, mortgage brokers, and we bring in special guests we'd start to think they're best in breed in their industry to hit them up for some questions, for some insights and some FAQs that a lot of our clients typically have when it comes to investing in property. And we are all about helping you make better property decisions. Joining me today in the studio is none other than Paul Glossop. Welcome, Paul.
Thanks for having me, buddy.
Mate, I mean, you've got an incredible resume, if I may indulge you a little bit. So the CEO of Pure Property Investment, you've authored a book as well called The Surfer's Guide to Property Investment. And I mean, you're someone that has not only lived and breathed the journey of investing in property, you've overseen thousands of investors go on the journey as well. And that's what I really want to try and unpack with you today is going from starting out to building a portfolio to then go to more complicated investment styles, say commercial or developments. And I know you've been down that path as well. Really just kind of take all that knowledge out of your head and be able to share it with people, because quite often to try and get a meeting with you at the moment, it's incredible, right? Super busy. So for us to try and take all that knowledge out of your head and share it, I think it's invaluable. So mate, welcome.
Oh, mate, thanks for having me. And long-time listener, first-time caller scenario. We've known each other for a very, very long time, and it's nice to become full circle and sort of come back to our roots where we all started conversations years and years and years ago between yourself and I.
Isn't it, mate? I think that's that mutual respect and admiration I've got for your business and seeing how you grow. And I think businesses that have gone on to kick some major goals like you guys have, multiple awards. And I mean, do you want to kind of share a couple of the more recent accolades that you guys have been recipients of?
Yeah, I mean, industry awards are not to say that they're a dime a dozen, but I mean, there's probably a few things that I'm personally very proud of within our business. Recently, we were awarded the Buyer's Agency of the Year as well as Buyer's Agent of the Year in the REB Awards, which is essentially the country's biggest real estate business awards.
Absolutely.
And probably even more personally, more of a proud moment than that is the acknowledgement of three of my team members for individual awards, both as women in business. One of my buyer's agents won and has been finalist as a buyer's agent in Women in Business Awards, as well as couple of separate awards for both client acquisitions as well as assistant and administrative awards in what we do and being recognised in that. So for me, the really proud moments we've achieved is really what we've achieved as a team. And as you know, mate, none of this stuff happens without literally really, really, really good people around you. And that's the part which I'm most proud of is we haven't lost any team members. We've only grown in our team members, and they're effectively the engine room and the reason why we are as successful as we are.
Yeah, I mean, it says a lot when on the business side, when you've got great tenure with your team, you guys are kicking goals on a personal and a business front as well. That's a direct reflection of the work that I guess we do for clients, which is they come back, they refer, they trust this, and it makes business a lot easier, but also means growing your team is a true reflection on, I guess, your ethos. And
absolutely, mate. And I mean, we go through that challenge a bit too, is the fact that, you go through busy times, which we are definitely in a purple patch at the moment, but in that you can go through those thoughts of, do we expand the team? Do we double overnight? And all those types of things which come to your head, because we could if we wanted to. But the reality is that we've got a true, a true and sound position of what we have to be reliant on to deliver to our clients, and ultimately quality is what we are always going to focus on. So we're never going to be apologetic if it takes a bit longer to get the correct outcome. We're just not going to be that company who says, okay, we've got demand, let's double the business or double the actual team to get the outcomes, because we just know that what ends up happening invariably is that the quality is what's sacrificed along the way. But anyway, we digress a bit there.
No, it's not. It's actually not digress, because I look at running a business, being entrepreneur, for example, very similar to growing a property portfolio, which is one of the terms that I use with my clients, being a propertypreneur. So a lot of our clients typically maybe are salaried, but they're looking at property as a way to grow their wealth, maybe diversify their own asset base as well. And maybe it's their ticket out of perhaps a corporate career and go, maybe I can get another income stream through property as well. So if you look at the parallels between running a business and then running a property portfolio, I think that they mirror each other very well, to the point that you can make very good decisions in business and in property And you can also make very poor decisions in business and in property as well.
And scale is a funny thing because, the potentially the, I guess there's been that whole raft of 10 properties in 10 years or whatever those essentially buzz
and you go like
catch-all
10x your business, right? Yeah. Same thing.
But you realize that, the reality is most people don't need to do that. And most of the time, if you are trying to do things really quickly, you'll make more mistakes than you need to. And you'll do things which were just unnecessary and essentially make yourself busy for busy's sake, as opposed to actually benefit yourself financially long term. And that's true in business as it is in property, is that less is more a lot of the time, and trying to understand why you're doing it. Is there a reason? If there is, great, go and execute, but don't think that you have to keep up with the Joneses, whether it's a value, whether it's an amount, or whether it's a total status thing. Because, I drove here in the same Mazda that I was driving, probably 6 years ago when I caught up with you for the first time, mate, and I'm a big advocate for that.
Absolutely. But I want to start off with new investors, because this is where I guess you and I, when we started our businesses, a lot of our work was newer investors coming into the market. When you're talking to new investors, what are some of the mistakes that you see them make?
Yeah, it probably depends where they've come from. And I'm finding more and more now when we're getting, and it always puts a smile on my face when I get a 20-something-year-old or even better, a teenager who's potentially thinking about or has already made a decision to move forward in property. And I'm a big believer that in property in the early stages is it's an enabler to do so much more in your later life, but you have to do something. And I'm also a believer that in property, there is no perfect asset for the person. It's a really true category of 80% or 90% is typically good enough, and taking action's a key part. Yeah. But a lot of the time it depends on where that person's come from and that key circle of influence, those 5 people around them, to see what they think their biases are already set when they come and speak to me or speak to my team. And
when you talk about biases, you're thinking Metro,
tax deduction,
regional,
brand new, whether it's a unit, whether it's a house, and whether it's in an area that they can go and see, look and touch it, or they can go through inspections, or where they're happy to go into state, or essentially all those biases typically are already there. So the challenge I have a lot of the time is we have to sometimes get to that position and say, where are you? What are you trying to achieve? What is possible? And what is possible typically is, especially those first investors, is you got to start with the finance, because people talk about, I want to build a portfolio. Well, that's great. But to be fair, we can't really talk too much about step 2 or step 6 or anything in between until we've got step 1 and execute on that correctly. And that comes back down to starting with what's your income, what's your borrowing capacity, what's your savings ability, what's your trajectory for your career to potentially earn more over time. What are you doing from a living perspective? You're at home paying next to no rent, or you're already paying rent. And all those things have to be factored in to say, well, you got to realize that we need surplus income after you buy this property to allow you to live, ideally allow you to service further assets if you're looking at buying. Yeah. We need to understand, realistically, what can you borrow and what property types are going to fit you best, and also making sure that your mindset is this isn't a 2 or 3 year plan. You're not going to buy it and in 3 years' time you're going to double that property and all of a sudden you're going to say I'm a success story, because I don't know anyone who owns one property, regardless of how good or bad it's performed, and says that set me up for life, unless you act on that, what that's allowed you to do. So starting with that holistic picture of saying, where are we? What can we afford? Both on the purchase price, what property type fits that? What cash flows do we need to consider for that? And then ultimately the last part is really, that's the product, is where are those properties right now? Which markets are going to give us the best 3 to probably 6 year horizon from a growth perspective? Because if anyone's telling me where they know markets are going to be in 10, 15, 20 years, I'm happy to hear it, but I typically will say, look, I'll talk to you in 10 years and you might be right, you might be wrong, I might be right, I might be wrong, but ultimately it's sort of a put your finger up in the air and check the wind sort of test. So really that's where we start, is that trying to get them to understand a little bit more about, don't worry about what you already know, tell me about what we actually know is factual. And those are those things that we can control. So start with what we can control, and let's move on to things which are going to fit that criteria and those objectives. And that finance person, so essentially the broker, is a very integral part, especially in that first investment.
And that's where I typically see people make a big mistake, which is they might put all their cash into that first property. Now it's locked their cash into that first property. They can't get it out, but they could have split a deposit, maybe buy 2 properties. And they're not thinking that way. And to go from 0 properties to 2 straight away, it's like, hang on, easy tiger. I'm like, I get that. But if we're not future-proofing your strategy, you're going to be locked with one property. It limits your ability to grow your portfolio. You can become that itchy, chasing the shiny object type investor, isn't it, that we tend to see from time to time?
Massively. And they're even basic discussions, which we probably gleam over a little bit and say they are basic, but understanding the difference of a 10 or 20% deposit, what LMI actually means, and not just how you calculate LMI. That's a very simple 1 second
Yes.
calculation that we just say, here's what a 400K, 10% deposit LMI looks like.
Yeah.
But it's essentially, what does that enable you to do? What is the cost? What is the risk associated with that? How much does that property have to increase in value before you can take equity back out? If you took equity out at 80% versus 70% versus 90%, yeah, all these things which we can rattle off and freestyle for hours, and it's easy because we do it for a living.
That's right.
But trying to get someone to say, understand what we're talking about, to then be comfortable with making a decision on pros and cons, because every action has that equal and opposite reaction where you have to understand that it's not just a straight linear line.
Yeah, exactly.
Yeah, which is cool, and that's why I truly, and I'm assuming you're in the same position too, mate. Is it? I love those initial conversations with people who are looking to get in. That's right, and have capacity to do so, because when they're in that stage, especially if they're in their teens or 20s or even 30s, you look at it and say, you got so much you're going to achieve by doing this, and that excites me.
And we can see it. We see the good, the bad. I say that to every client. We see the good, the bad, the ugly. So those that have gone to do some incredible things with their portfolio, the ones that have made mistakes, and I guess where their blind spots at times as well, isn't it? Going, you might make that mistake, and if you want to be adamant and go ahead and do it, we sometimes have to sit back and watch it happen, unfortunately.
And you don't necessarily want to be responsible for it, because, and that does happen from time to time. So look, if that's what you want to do, that's great, but we're probably not going to be the people to assist.
Perfect. You mentioned just earlier about, you're looking at the suburb location or the property type, for example. Now you've seen, I'm going to say, thousands, maybe tens of thousands of properties. So you have a trained eye, and your team has a trained eye. So I guess you go from taking a brief from a client to then going, okay, we're going to look at these particular corridors or these areas, and then down to like a suburb street and a house level. How does that filter work in your team without giving away your trade secrets, perhaps?
No,
yeah,
absolutely. And I'll be completely transparent. I mean, to be fair, there is no trade secrets. And if someone's going to try and say there's a secret sauce to it, ultimately the secret is that mastery, that 10,000 hours. That's effectively the secret. Is you do it all day, every day. You figure out how to get pretty good at it. And the other part too is that I'm never apologetic, in the sense that myself and every single one of my team members who works in my business are all property investors. Every single one of them have bought property, and typically the average portfolio size within my team sits around about 8.5 now.
Fantastic.
That's between 6 members. So there's a lot of experience of people building their own property portfolio. They've done it before. They've made mistakes before, but they've also got in excess of 90 years experience collaboratively between my team. So that allows us to make, like you said, pretty quick decisions on things which make sense, don't make sense, or maybe a little bit grey. But if we're considering going back to probably using the avatar of that first investment person, and someone who's trying to consider, this is something I want to be a cornerstone of me getting further in this portfolio build over the decades, is typically, and I say this typically because it's not a hard and fast rule, but I would typically like to see land. And when I say land, it doesn't necessarily mean to say it has to be a freestanding house, but it has to be a good percentage. And when I say a good percentage, typically we're sort of hovering around that 60% of the purchase price should be attributed to the actual land value.
Okay.
So whether you're buying a 3-story walk-up red brick, which has got 7 in the apartment or 10 in the apartment, but the actual land value is worth a lot more, and there might be a higher density zoning overlay right through to a suburban house that's got a 600 square metre block, and it might be a 25-year-old home that's got a decent plot of land, minimal supply in that particular area for that particular property, and also then considering other aspects in regards to where is it located, orientation, things like sunlight, things like walkability to major amenities, schools, hospitals, rail. You start to then consider it all down, and obviously you're starting with a budget to say what fits within that. And then also overlaying it all to say where is that actual property type in its current cycle right now. And it's a bit of a tricky one because we're sort of mid-2021 and essentially the whole country's on fire. The whole world's on fire when it comes to property, not literally, but figuratively, in the sense that you're sort of seeing you could poke a stick at probably, I reckon, 100 LGAs right now, and you'll probably find a lot of them will show 15 to 20% growth this year. Very, very uncommon. And you and I have been in property for a very long time. You'll know that this is not what happens in growth cycles. Growth cycles happen, and 15 to 20% does happen, but not ubiquitously. Not seeing point.
You normally have some markets that, I mean, we'll go to touch on Hobart. I mean, you first flagged Hobart with us, and I'll put my hand up and say we missed that boat. You flagged it with us and said Hobart has done nothing for ages. And then what were the markers say on Hobart that you picked up on?
Yeah, and that's a really good point, because if you go back to like normal cycle growth and when it happens and how it happens, Hobart, we started buying there back in 2015, probably to the end of 2017. And that was a market which, as you said, previous 7, 8, 9 years had done very poorly. And if anything, was probably at that time the worst performing market over the previous decade in the country. Yeah. Fast forward 6 years, it's number one, probably somewhere between ACT and actually Hobart being the two main capitals that have actually done the best from a capital growth perspective. But it came out of a time where they had built, when I say built next to nothing, it was in the single 100, I think it was somewhere between 100 and 150 properties on average per year for the previous 7 or 8 years. Wow. So supply basically was never increasing for the previous decade. Granted, they didn't have much population growth for a period of time there as well, but it started to see a trend because their economy turned a big corner from the worst unemployment rates in the country to close to becoming the best. They had a big transition from where they were previously to tourism, hospitality, as well as tertiary education. So they had a push to say that we want to attract new people, which in turn meant attracting new jobs, which was happening. You already had vacancy rates sub 1%, so rental market was extremely tight. Supply was non-existent. All they needed was demand, and that demand started. And when you start to see population growth heading upwards, unemployment rates heading downwards, you start to see it's a pretty simple way to say, okay, I can calculate it all. And the typical outcome is when you get demand exceeds supply, you get property price growth. Yeah. To really null it down to as simple as that, that's what happens.
As you've gone into build property portfolios with your clients, what has been their transition? Do you feel like going from that first property to then, the third, fourth, fifth, and then ultimately I want to try and touch on commercial, for example. But what has been, I guess, that continual growth that you've guided your clients through?
It's a really enjoyable part of what I do now in my role, because I've got clients who've been with us for 5, 6, 7 years now. And in that time, we've got clients who've built portfolios in excess of 30, 40 properties. In that time, we've got clients who are buying their third, fourth, fifth property. Yeah. And the growth comes by probably a few things, but that comes by buying really good, simple to understand properties which have performed consistently, cash flows being consistent, allows their borrowing capacity to stay relatively predictable, and allows them to keep moving forward first and foremost. But it means that they're sort of going through a transition of walking before they can run. So they're not saying, I've bought my first property, now I'm going to go buy a development site, then I'm going to go buy a commercial site. And then essentially I'm going to retire and I'm going to be the next, there's so many different people we could rattle off. But ultimately they're not trying to think, okay, I'm 29 and I'm going to retire from my job, because the reality of that happening for most is very unlikely. But I've found that the role that we have is to say, keep caution and keep that sort of a bit more of that Hippocratic oath to say, first, do no harm. Make sure that we're in a position to say we can get moving forward, we can keep moving forward, but we don't necessarily need to risk everything here. We've already made a good start, so let's try to repeat what we've done for the second. Typically the third, and still that focus is on good land component, which will see that good organic growth, 60% of purchase price in that value of that particular property, looking at all those supply and demand factors that we have to consider. Diversification starts to become a bit of a consideration as well.
Diversification
is in location. In location. It doesn't necessarily have to be state per se, unless we're encroaching big land tax issues, which is not that common in most people's portfolio until you get into the upwards of...
For the record, land tax is a cost of doing business as well, right?
Absolutely.
Just like tax in our business.
I pay it a couple of times over every year, and it's punishing, but it's allowed me to do a lot more. And that is it, and you have to acknowledge
if you get hung on land tax, you've missed the point of investing in property, I feel.
Absolutely. And I think if you're hung on any tax, and that is the biggest drama, is that people think, I'm not going to buy that because of this tax outcome, whether it's beneficial or it's going to be a hindrance. You really aren't. You're missing the point in general. But I guess digressing, going back to where we are, so the process and the transition from first purchase to probably second, third purchase, I typically find doesn't change too much unless someone's income levels or their lifestyle levels change exponentially, or alternatively, their actual personal circumstances. And when I say personal circumstances, what I find a lot of is that when we go from that first investment and we go back to use that commonly used phrase of the rent-vestor, a lot of the time people are sort of considering, I bought the first investment, it wasn't my home, I haven't lived in it. Bought my second, not my home, I haven't lived in it, don't intend to. And life might be changing where you've got a partner, you might be expecting a child, and then from there you think, well, do we want to keep renting or do we want to keep living at home, or however we're doing that? Which is
exactly our journey, which is buy a couple of investment properties, and I was like, hang on, we actually want to put down roots because we're having kids. And it maybe just puts the brakes on your investment property plans for a while, because now you're carrying a big owner-occ component as well.
Yeah, absolutely. And it's not to say that people should consider that as a noose. It's another step in what you're trying to do, because at some stage as part of this process, most people are saying, I want to buy my family home.
Yeah.
It doesn't mean it has to be immediately. And you'd know better than I, is that sometimes buying it immediately puts the brakes on a lot longer and a lot more firm for people who want to build a portfolio, because they might say they go into their maximum borrowing capacity, and people who are based in Sydney, Melbourne, Brisbane, basically anywhere now, if you're going to buy that owner-occupier or buy a home, you're going to be spending a lot of money, and you're probably going to run that LVR to as high as you possibly can, and you're going to be very skinny on your cash flows, and all those other things mean that your property investment journey, which was maybe buy an investment in 2 years, becomes 10 years.
Spot on.
And then you really say, well, you've pushed out that delayed gratification. The compounding factor then takes a lot longer to actually give you that outcome. So if you're in that position, or if our clients are in a position where they've bought a couple of investments and say, we want to buy a home now, it's not an issue for us. We say, well, this is an opportunity. And basically it means that if we're sort of looking at this whole 30-year plan, that property is part of it. Now, whether it comes sooner, whether people are comfortable saying we'll just keep renting, we don't know where or what we're going to buy, but that's that consideration there. But when we're talking about things like going to developments or potentially buying commercial, if I look at development in particular, one thing we do try to consider is if we're buying property number one, but definitely 2, 3, 4, if we're buying residential freestanding houses as examples, we do try to consider buying properties that have development upside. Now, it's not to say that we're ever going to develop it, but trying to buy properties with that opportunity, because it doesn't mean you then have to go and buy a property and develop it immediately for property number 4, 5 or 6. You might have bought that property 1, 2 or 3.
And you can slate it for 10 years down the track.
Exactly. And you've got 5, 10 years of capital growth, which has made that margin for that development upside far, far greater. Your construction loan or your LVR is a lot easier to come across, and the money and the banks coming and being comfortable with the lending there. And your margin in that development typically is exponentially higher, because building costs move typically with inflation. Property prices not necessarily in that same vein. So it gives people a lot more opportunity to actually not necessarily think about buying a development site. They might have already bought it, but they've let it mature for 10 years. And it's essentially just a standard residential property that's had decent cash flow. And that's, from my end, I've got clients who have bought assets which they've bought 10, 15, 20, in some cases 30 years ago, now in the position where they've been rezoned to allowing for a duplex, or further for a townhouse site, or even further for in some cases, small unit complexes. And they're the ones who have that exponential wealth transfer, because they don't sell. It's not that complicated. They buy decent assets in decent areas, and they don't get too edgy when the market doesn't do what it wants. They don't get too excited when the market does what they want. They don't sell it. They hold it, and eventually they bear the fruits.
I guess that transition to developments where you just mentioned granny flats, duplexes, subdivisions, for example. What are some of the other examples that you've worked on?
So, I mean, I look at a number of things. I'm personally working on a big subdivision myself in a residential purchase, which is a 2-hectare site that's going to be probably an 18 to 20 lot subdivision, all the way through to small boutique unit block developments, also 1 into 3, 1 into 5 lot subdivisions for higher end sites as well. And when I talk about those different angles, obviously it comes down to cost of transaction. When we start to go up levels of these different aspects of development, you start to realize that it's not only complicated in understanding ROI, it's complicated in understanding funding, which is a big one.
What I was about to say, and getting the finance, especially for new players in this space.
And that is probably where you Google or you Facebook or your Instagram search for development site companies or whatever, you chuck a couple of keywords in there, you'll be followed by everyone and anyone who's going to promise that you'll be a developer tomorrow and no money down and all the rest of it, and essentially syndicate works. And it is that point in time where it's so exhausting to watch people make the same mistakes over and over and over. And ultimately, all the promises are fast money. And if you want fast money in property, my personal stance is that if you want it, you get what you deserve, which far too often is going to be the opposite outcome. And typically the people who are looking for someone to blame as opposed to taking responsibility for those outcomes themselves as well.
Yeah, great. It's a bold statement, but it has to be said.
And there'll be people who will refute it, who have had money made in development sites and have money made in syndicates and those types of things. And there absolutely are ways to do it, but there's also very, very simple ways to lose your money. And for me, I'm always a big firm believer in that property is a very illiquid asset. It's very expensive to get in. It's very expensive to get out. And to your point right at the start is that once you're in, your money's locked in. Yep. So don't think that property is going to increase in the next year by 20%. You're going to take that equity out and reinvest it. If it happens, fantastic, but please do not plan for that, because in those cycles, if we're talking 10, 12, 15-year cycles, it'll probably happen once. If you're lucky, it'll happen twice.
Yeah.
Outside of that, it's very boring.
Yeah, correct.
And if it isn't boring, you're probably buying properties which are high risk.
Fair, very fair. Which brings us to that last bit, which is commercial. So when are you recommending commercial for some of your clients as well?
It's a very much, for me, it's a specialised position. I'm always a believer in commercial. It does fit in a lot of portfolios, but it fits for me as a bookend.
Okay.
So the way I consider commercial for the most part, and I generalise, but if I were to generalise who fits commercial, it's typically when they've got a portfolio of assets, whether they're resi with development upside or a combination of those, as well as typically their principal place of residence. If they know they're going to buy it, they've already bought it.
Yeah.
As well as things like knowing their cash flows really well, knowing their income position really well, having a good surplus, having a good buffer, and then saying what I'm really trying to achieve now is I'm trying to achieve a bit more of an income generator. Okay. I'm not looking at an investment that's going to be a high growth investment. Not to say commercial doesn't grow, but the predictability of it in a lot of circumstances is based on location, based on asset type, based on lease type, based on where the cash rates are on the given days. It does dictate a lot differently as far as where the metrics move. So we look at it as to say the intention of that commercial is to increase your income across the portfolio. And to give an example of a $500,000 7% net return asset, if we're looking at that as a 30, 35K a year after all said and done income, and you're borrowing your money at 3%, it's a good margin. You're talking 10, 15 grand a year net on that particular asset. However, the issue that comes a lot of time is people think, okay, great, I've got 10, 15 grand a year income in addition to my 200 grand a year combined household income as an example. That should improve my serviceability. The challenge with commercial most of the time is that A, higher deposits.
Correct.
B, the shading is typically a lot more aggressive. So instead of maybe taking 80%, they might be taking 70%. As far as when I'm talking about shading, the bank's taking that amount.
What the banks will use as the rental income.
Exactly. So on paper, you might be earning 15. From bank's eyes, you're earning 0, and you might just be breaking even. So essentially, they're saying it hasn't improved anything. And in that same circumstance, to then go and re-leverage any equity out of that property typically becomes a lot more difficult.
Yes.
There's less lenders in that space.
Lenders, the ability to pull out equity from commercial becomes a bit more of a challenge as well.
Exactly. So I guess for all those reasons, we don't necessarily like to see it too early in the piece, because if people do jump in, it's usually a bookend anyway.
Yeah.
So it's a bit of a stop in a portfolio, whether you like it or not, unless your liquidity is high, your income's high, or your combination of the two. So I guess commercial fits. Things that we probably are a bit less bullish on in the commercial space are the what was 15, 20, 30 years ago, strip mall retail, hospitality, high-rise, high-density office. There's probably a few categories in there which are definitely much higher risk, and banks do perceive them as high risk now as well. So you're going to see that they'll categorize them differently, which in turn means you're probably paying a higher interest rate. You're going to be required for a higher deposit, all those things. So traditional, industrial, bulky goods, medical, aspects that you can understand have got a business type and a demand which has got 50 years left ahead of it before we see, what the next Amazon's going to do to the industry, or to essentially what the commerce space does. We're recording a podcast here in a studio that ultimately 5 years ago this didn't exist.
Correct.
What happens from this now, and in saying that, where does this go from this point onwards? The evolution of these types of spaces is literally on a monthly basis. Things change, and the demand for the space that we're recording this studio in changes. So we don't like to probably buy assets which are within property types which we just don't have a clear predictability outcome in there. And in turn, it's pretty easy to figure out where the risk is, because if you categorize what the banks are putting their risk appetites on, you can pretty much see where the risk is in certain industry types. It's not that complicated. And you can ask your broker to say, hey, what are the tiering or the categorizations in property types? And you can kind of see what industries are probably at high risk than others.
Yeah, well said. I think you touched on a couple of good points there, which is follow the bank's appetites, whether it's LVRs, whether it's postcode listings, whether it's the property type, whether it's the industry type. I think sometimes we can rush into it, and those are the mistakes that I see people make, is they rush into the decision, and it's that confirmation bias going, this is a good decision, and we're coming in going, but hang on, this is the reasons why it actually may hold back your portfolio, whether it's residential, goes for commercial as well, doesn't it?
Yeah, absolutely, mate. It's no different here. Commercial, resi, same thing. The same appetite, same risk categories apply. So so take heed to that advice from your broker, and from your brokers pass on their advice from what the banks see it, is that it's not them making it up. Those things exist for a reason, and typically there's a lot of data that supports why they're categorizing things the way they are.
Wonderful, mate. And just on a personal note, on your property journey, take us through some of the war stories. So I like when investors share not only the great, because you've obviously gone on to create a thriving property portfolio, but some of the horror stories maybe, or just some of the things that you've learned perhaps.
But the beauty of it is that, I mean, I am always investing, so I haven't stopped, and I will consistently move forward with that. And the evolution of my own portfolio is pretty similar to what I've discussed, where starting with buying multiple residential assets, predictable, decent cash flow, major CBD markets in areas which I know aren't going to be a flash in the pan, aren't going to be next or tomorrow's back paper or front paper success story, and then the year after that's going to be their failure. But probably some real simple takeaways I would personally always portray is buy what you can afford to hold, but don't sell unless you truly see a benefit from a cost benefit perspective. When I say that, if you can't move forward and you need to sell that to move forward with something that's going to be a better outcome than what you already own, property is going to be a pretty simple thing to say. If you sell it and you have no reason or anything to do with that money, maybe reconsider. But when it comes down to that as well, is buying properties with some sort of value add upside. And I'm probably of a position now where well over a decade on of starting to build a portfolio, I'm circling back to properties that I bought a long time ago and are now to value add them. And it's not just because the margin has increased and the property prices have increased, because sometimes you don't need to develop to make money. And a lot of the time you don't. People get a bit sidetracked, say, I'm going to develop the property and make money. Well, to be fair, the market will make you the majority of the money you'll make in property. But having those properties with that development upside is always going to give you more options. Once you understand that you can keep building your cash flow, you're not going to essentially retire on property by equity gains. At some stage, you have to retire debt to then see an income. And that's the part which I've probably transitioned in the last probably 3-4 years of my investment journey, is buying properties which I'm actively manufacturing. And that's from simple duplexes to multiple duplexes to larger townhouse sites to 20-lot subdivisions, with the intention to buy, actively develop, sell a portion but retain, and retain a portion with no debt to then hold that as a long-term cash flow generator. And that's really been my position. And all the while, I've been using those initial properties that I bought. The equity in them has allowed me to do what I'm doing now.
So you piggyback those early properties then?
Piggyback them in a way that's still being cautious, where it's all good and well, but I'm not taking my LVRs up to 90% or even 80% anymore because I don't need to. Back when I was building it, yes, I did need to. And that is a certain level of risk that you have to be comfortable taking, is that worst case scenario, you're back to square one. But that is the part which, as my personal journey increases, and also as we see our clients build their portfolios, is we probably start to dilute the risk a bit more, because there's more to lose as your portfolio grows. So not taking that LVR to 90%, maybe dropping it to 80%. Once you're at 80%, maybe considering, do we need to really take it all out, or we only take what we need, keep that LVR lower? And as you know, from the brokerage side, it is beneficial because you're far more attractive to the banks. Better rates, more liquidity, more fluidity when you're making decisions. So it starts to sort of allow you to be more creative if you're not as risky, which is quite ironic when you sort of think about it that way. But that's probably the part which I'm now enjoying, and moving into some industrial as well as commercial development sites as well.
Excellent. Mate, Peter, we could talk for hours
Always,
on this.
Mate. Absolutely.
Absolutely. But I want to say thank you very much, Paul.
No, very welcome, mate. Thanks for having me.
We'll put all your details. We'll put a link to your book as well, which is a great read. So thanks very much for coming on, for sharing your knowledge, and I hope you found that helpful. Leave us a review. Leave some comments as well. If you've got any questions for Paul, please hit us up, and we'll join you on another episode of the Australian Podcast very soon. Thanks.